Yeah, I feel bad that the final Jedi Options segment is me riffing on a long put. Probably the strategy I do the least. But it is apropos of a market like 2022, right? What better type of market for you to get an understanding of the power of buying a put option and playing the downside. So if you take a look at the S&P, we try to make these timely, right? So some of the conversations are timeless. It doesn't really matter what's going on in the market. Today was kind of came from what the market looks like. So, well, what makes sense here? As we articulated earlier, this is a downtrend in the S&P. It's been chopping sideways this week. We're sitting at a potential short-term support level. If you break that support level, we could see some further downside. So that makes you think about bearish opportunities, bearish ideas, bearish strategies. There's a million different bearish strategies that you could do. But the simplest, the most straightforward, probably the easiest to execute even, is the long put, buying a put option. So what I'd like to do here in the next 10 minutes is walk through some of the general guidelines and principles behind buying a put. How do you do it? Which one do you buy? How do you enter the trade? Those kind of things. Okay. Now, with the S&P having this bear breakdown pattern, you could obviously just buy puts on the S&P, or you could say, screw the S&P, let's buy the NASDAQ, buy puts on the NASDAQ because they hate growth. Maybe that'll sell off further. Or maybe do small caps. You can quibble among the indexes, or you could pick an individual stock, right? Just say, listen, I need to add some bear delta to my portfolio in the event this spins out of control here. And so I'm going to go to the scouting report and I'm going to find some quality swing bear setups. The one that I want to highlight today is NTAP. NetApp. This is a software company, if I'm not mistaken. It's in the growth category. It's a volatile stock. It moves a lot. So this could get hit. Okay, this could get hit here. And it's never a good sign when you pull open a chart and the stock's at the bottom right. It's like the lowest it's been. It usually means the stock is in a downtrend. Not even usually. It always means the stock's in a downtrend. And it looks gross. It looks gross. But that's what makes it such an interesting bear candidate. I mean, if I look at the pattern here, I've got a downtrend below all the moving averages. You got this little consolidation over the past week, has not been able to get off the mat. You've now tested $58 about 4 times in the last 6 days. The more times you test it, the weaker it becomes. The assumption is this could break and go lower. You look at the weekly chart and you're going to find that it's got room. Like this is part of the spookiness, just like the NASDAQ is testing support and has room to drop it if it breaks it on the weekly. NetApp is testing long-term support, and if it breaks it, it's got a lot of room to drop. Makes it an interesting, potentially attractive bear candidate here. $58, that's good. It's tough to buy a put on a $500 stock. The fact that this is 58 is going to make it a little more easier to swallow, right? Easier to pull the trigger. So how do I buy a put? Well, I go to the trade tab and I got to figure out what month I want to buy here. Now, the pitch is that this is more of a swing trade, right? I don't want to go bearish for 6 months on NetApp. That's too long. But I'm not sure I want to go bearish with a 23-day option. Jan has maybe 3 weeks left. I'd be okay with that if you think you're going to be in this trade for a couple of days and then gone. But prudence kind of demands that you maybe buy a little more time than you think you might need, just in case. You also minimize the time decay. So I'm thinking February is a sweet spot, 51 days. It's good, I think, rule of thumb for buying puts for a swing trade. So you open up the Febs. You take a look at the strikes that are available. Again, the stock's at 58. And you could buy a deep in the money put, but why? I mean, the whole reason, at least part of the reason why you're buying a put instead of shorting the stock, is because you want to cheapen the trade. Well, if you buy a deep in the money put, you're not cheapening the trade. So that doesn't make sense. So we could buy a little bit in the money. Okay. The first strike in the money is the 60 strike. It's got almost a 60 delta. Okay. And that's a common rule that you'll hear us talk about. Buy a 60 delta put or buy a 60 delta call. Because it's a little bit in the money. So you get a little bit of intrinsic value. It's not a lottery ticket. But it also is not super duper expensive. Right? So strikes the balance between having some intrinsic value, but not being overly pricey. I think this one could work. Buying the Feb 60, only $3.60, which isn't terrible for a stock as volatile as NetApp. Or I think you could buy the first strike out of the money, the 57.50 for about $2.30. Now, that's going to be a little bit more aggressive in the sense that I now need the stock to drop further, but not by much. You're getting about a 43 delta. I like both of these. If my desire were to make the trade cheaper so I didn't need to use a stop loss or I could really have a loose leash on that stop, I think the 57.50 makes a little bit more sense to me. So let's build it with that. Okay, let's build it with that. I'm going to click on the ask price to buy the call, and by default, it buys it at the ask. Okay, well, this is a 10-cent bid-ask spread. Usually you can split it. So I would try to get it at 230. Okay, and it even shows it down here that that's the midpoint. Okay, so let's think about that for a second. 57.50 put, paying 230. If I go look at my chart, right, I'm buying this slightly out of the money, 57.50 put, and I'm paying about $2.30. Now, I could do the math in my head here and tell you that essentially means you need this put to be $2.30 in the money at expiration. And that puts your break even around a little over 55 bucks. Okay, a little over 55 bucks. Now, I can tell you that I think 55 bucks is realistic in the next 51 days based on the weekly chart, based on this ATR. I think it's realistic. It's a couple ATRs away. But the other thing is, I'm not going to hold this to February expiration. And the thing that you learn about buying options is it's kind of a race. Every day, the break even gets a little further away, a little bit further away, a little bit further away, because time decay is chipping away at the value of the put. So if NetApp drops quickly, I'll immediately be profitable. I don't need it to get to 55. That's really just if all the time decay is priced out and we're at expiration. Okay. So today's break even is essentially the current price, right? So I'm just wanting this thing to head lower, hopefully, below 55 at a certain point. So if I looked at this today and I said, I want to enter right now, I think this has already triggered. Just get me in. Well, if that were the case, this is what the order would look like. Just buy it at the current price, midpoint, with a limit order. That would get you in, okay? Or maybe it hasn't triggered yet. You say, you know what? I don't know. This is a doji. Yesterday was a doji. The prior day was a doji. 2 days before that, a lot of dojis here. I don't know if I'm convinced yet that this is breaking support. The S&P hasn't broken support yet. Okay, the NASDAQ technically hasn't broken support. Small caps really haven't broken support. They're all kind of sitting there. So you could buy the put today in anticipation that they all fall over, or you could say, I'm just going to tee up the order, and then I'm going to make them pull me in. I'm going to make, in particular, NetApp. I'm going to make NetApp break today's low, which seemingly would be a little more convincing than being a doji, right? So 58.08 was the low. Let's just go 58 bucks. So I can put in a trigger on the order using this condition here. And I can say if NetApp gets at or below 58 bucks, then buy the put. Now, you have to specify what price you want to buy the put for, okay? It's not going to be at $2.30 anymore because the stock will have dropped 50 cents by the time it triggers. So you know the put's going to cost more. So you have a couple of choices. You could route a market order. Say, listen, I don't really even care. Just get me in. Okay, just buy it at whatever price it's trading for. Which that could be okay if you're trading really liquid options like SPY, where the bid-ask spread's a penny. You don't usually get hosed with market orders. It gets a little bit more dicey when it's an illiquid option. Okay, so you might say, you know what? Let's do a limit order, but let's just link it to whatever the midpoint is. And that's called the mark in Thinkorswim. So I can say route a limit order and just set it at whatever the middle of the bid-ask spread is at the time. So if the option's trading for $3 by 320, it's going to route a limit order at 310 and try to get me filled there. So that gives you a little bit more control and maybe comfort knowing that you're not going to get screwed as much if the market order fills. So you can manipulate the order a little bit. And on a side note, this is quite lovely, right? I have an immense amount of control over how the order gets routed. it's just beautiful that we have so many different ways of structuring it at the beginning, right? But that would be a contingent order if NetApp breaks 58. Okay. For today's video, I'm not going to go too much into targets and stops. I really wanted to just focus on the entry. So to sum up, you're buying, in this case, about a 51-day put, slightly out of the money with a trigger if NetApp has this support break. Ideally, that's going to be corroborated by a break in the indexes. That would be ideal for this particular trade.